The Fed called an emergency meeting which triggered QE4, but it's important to note this is totally not QE4, it's not QE at all, in fact, it's just love. Fed love is the best kind of love. Wow. Well, the ignorance is mind-numbing at this point, it's absurd actually. People don't want to realize how bad it actually has become. Sure, stocks can go higher. Devalue the currency and you will see the results. Venezuela is the extreme example. But the central bank should always admit to their actions, and in this case, they're hiding, and they will most likely succeed in destroying the financial system once again. You came here for the truth, so let me unveil that for you. Today I have a bunch of information to get into, and we're going to look first at what happened with the Federal Reserve. The mainstream media isn't covering this, but I'm going to show you the data directly from the source itself. We're going to look at what's happening with buybacks. I have a lot of information to cover, charts, articles, everything in between. Let's get into it right away. Take a look at this directly from the federalreserve.gov website, and you can see the Q&A that they have right here. The date on this is October 11th, 2019. What process did the FOMC follow to approve these actions? They're talking about the monetary policy implementation, and you could see their response. The FOMC met by video conference on Friday, October 4th to discuss issues related to the recent pressures in money markets and monetary policy implementation. There was broad agreement following that discussion on appropriate technical operations to address these issues. Specific plans were developed for review by the committee this week. As noted in the announcement, the final plans for these technical operations were approved by notation vote that was completed today. This is an emergency that they had to call to action, and it happened just like that. This information should be on the front page news, but it's not. It should be talked about by CNBC and Bloomberg and others, but it's not. Should that surprise you though? Of course not. That's the way that we have to deal with things today. We always have to look a little bit deeper. Now this is public information. Here it is if you want to see it, federalreserve.gov, but most people will not be bothered. Of course, all of this information is generally suppressed because you are focusing on what's happening with this person or that person, and they make such a big deal about all these issues that are happening, and unfortunately that is completely beyond the scope of the average person. Well, I'm going to bring you some more data right now that I do feel is important for the average person. They need to know about this, even though it might not be as interesting as what the Kardashians are doing or the most recent sporting event. This here is key. Rabobank forecasts of the FOMC decisions, they do believe that we will be back down to 0% by the end of 2020. I do believe that it will actually be faster than that, but let's see what happens as time goes on. This is going to affect everything. You're going to watch as the mortgage rates decline again, even though they should be higher because the risk taking is at an extreme level. In Toronto, just as an example, where you saw mortgage rates decline just a small amount, I'm talking very small, the bubble went to extreme levels. In fact, with that marginal decline in mortgage rates, we have seen now UBS has a report out. I'll try to do a video about it, essentially saying that Toronto has become the second biggest real estate bubble in the world today. That is insane, and all because of what's happening with interest rates. The same goes for what the Federal Reserve is doing and what all the other central banks are doing as well. Bank of America put this together using data that they found from the EPFR, and it shows you flows surging into money market funds despite falling rates, just like 2007, 2008. And you'll see here money market fund flows, which is the yellow portion, extreme levels not seen for a decade. This just shows you what has been happening right now as people, investors, companies prepare for worsening conditions. We need to see actual changes happening to the financial system in order for there to be a restoration and fundamental differences, but that doesn't seem to ever happen. This is just a chart that I thought was important simply because of the fact that we have watched time and time again as those individuals out there in the mainstream media have been talking about how fantastic the market is doing, but you are seeing all the data from the EPFR suggest otherwise. It suggests that that so many have pulled their money out. Now they consider this to be bullish because they're saying, look, if all this money is sitting on the sidelines and everything is totally fine, once the people realize that, what's going to happen with the money? They're going to start putting that back into equities. Well, you do what you want with your money. I am simply looking at the data and I bring it to you. There are a couple points here in this article that I wanted to mention really quickly. Profits pinched. Global profit growth stalled in the second quarter, depressing business confidence and leading to cutbacks in capital spending worldwide. The danger is that profit-pinched corporations will take the chop to their workforces, knocking consumer confidence and spending for a loop. We have seen this not just in retail industries, but of course, this has been happening as a widespread activity. Squeezed central banks. Monetary policy may be easier than at the start of the year, but central banks in some cases may have been too slow to act. This is what they're saying, not my opinion. The Federal Reserve has cut its benchmark rate by about 500 basis points in all three recessions since the early 90s, yet it began this year with only half of that amount available. So think about it. In the previous instances, they had a long way to go down to get it to zero, but in this case here, they have very little room, and it is expected that the next Fed meeting we will see yet another cut in interest rates. It seems like the zero level is going to be reached very rapidly. There's more in here if you want to read about it. Definitely check it out. The links will be in the description. This just shows you the level at which the buybacks are taking place this year. Now, I had some discrepancy in the information I've been picking up throughout the year. What I had just heard is that we are now 20% year over year on the buybacks. Last year in total, there were $1.1 trillion worth of stock buybacks. It was a record. This year, we are planning to exceed that. I want to see what happens exactly because this is the number one buyer of stocks. There's no doubt about it. It's unbelievable because even these massive institutions have been unable to exceed the purchasing that we are seeing from the companies themselves that issue debt and then buy up their own shares. It's a crazy policy, but it's going on at a record rate. This is the chart that corresponds to that data. You could see corporations at the top of the list. It is unbelievable, but this is what's happening. You can see that they are by far the largest purchaser. Not even close when you look at foreign investors, pension funds, mutual funds, and so on. This is far exceeding the rest. Once again, pulling data from the EPFR, global equity and bond fund flows by quarter. They give you the breakdown there if you're interested, but the blue line is bonds, the black is equity, and clearly we can see a trend all throughout 2019. And in fact, if we go back even further, you could see it for yourself. Looking at the fourth quarter of 2018 and the trend line, which we have witnessed, has been selling off equity. Money is leaving equities, and of course, it is going into what they believe are safe havens. In this case here, bonds are definitely seeing a lot of money flood in towards it. That's why at one point we had unbelievably $17 trillion worth of negative yielding bonds. That number has come down a few trillion, but hey, at this point, who's counting? This just shows you what actual investors believe is going on. Global equity and bond fund flows by year. Equity is the gray line, bonds are the blue line, and you could just see the comparison in between these two. There's a lot of money here that is going towards bonds at this time, and equities are seeing outflows like crazy. Of course, the last time we saw this was the financial crisis, but can't mention that because people get scared. Global consumer confidence, GDP weighted average of consumer confidence across developed economies, coming from JP Morgan, showing us that since the financial crisis, it has been accelerating. This has looked really good, except throughout 2018 and beyond, it has been declining. That's not a good sign right now because of all the stimulus measures, because of everything that governments have done in order to keep this afloat, how to create something out of nothing, and yet we still have global consumer confidence waning. The next few charts here are talking about the IPOs, and it's quite interesting to see this because there's so much media hype surrounding a lot of these companies. We have seen Beyond Meat, it went up, I think it was 400 to 500%. It's insane. And then you look at these other companies on the complete opposite end of the spectrum. We're seeing Uber, Lyft, Peloton, and Slack. All of these companies here have performed very badly over this period of time. That's not a good sign because the money is flowing into these companies unknowingly, thinking that this is going to be the next big thing. Everybody wants to buy in these particular IPOs and hopefully strike gold, but it doesn't seem like that's happening with so many of them. Yes, there are certain instances where you can do very well, like in the case of Beyond Meat, but even in that stock, you're looking at it right now, from its absolute peak, it has come down approximately 40%. So you would have to have got in at the absolute IPO price in order to see the gains. Many people got in at the wrong time with this company thinking, can it go up higher? Can it go up higher? Oh my goodness, I'm going to miss out. And then of course we have seen it declining ever since. It is very dangerous for a lot of people who really don't know about this particular company. They don't know about the stock, but they want to put their money in. And of course, as a result, on average, we have watched just over the last little while, these particular stocks down almost 16%. You're looking at this index from the peak in July to right now. Those companies have not done well, and the central banks have allowed this to persist. They've been pushing these easy monetary policies, and people are looking for a place to park their money. They don't want to put it in a savings account because they're not going to get any return. So they go for the higher risk propositions, and in this case here, it's not faring well for so many. Just wanted to finish the video off by taking a look at what's going on with China and the US. I want to make this very clear that the trade deal has not gone through. There is nothing at this point. Nothing has been signed on paper. Nothing has been agreed. We don't have a solid agreement on either side. We have seen this before where they claim that everything is going well. Everything is done. We're just going to sign on the dot. We'll meet you there on this day, and then everything falls apart. Now, I'm not necessarily saying that that's what's going to happen this time around, but this isn't a trade deal. All it is that China is buying agricultural products from the US, but we have the media constantly projecting this, and it is quite embarrassing at this point to see how far they are willing to go. I want to see the two sides get along. I don't want to see them fighting every day because, of course, that geopolitical tension always sparks danger for the average person. The average person never wins in this case. Here's the chart that corresponds to that. You could see clearly that over the last couple years, China had been purchasing less agricultural products from the US as the tensions were heated. As a result, the US spent a lot of taxpayer money to bail out the farmers, and so we will see what happens in the future here. I just want to show you that all of this stems from these incorrect central bank policies. What they do is devalue the currency intentionally and destabilize everything top to bottom. That's all for this video. If you found it informative, hit the thumbs up button. You just have to click one button to support this channel. I do appreciate that very much. If you want to make money, if you want to build a business, if you want to learn about passive income, then I have a step-by-step guide how to learn to sell on Amazon. There is no other free guide like this. It is a massive series of videos for you. There is no catch. It's at the AmazonGPS.com. If you want the financial education that was not taught to you in school, then I have what you need. These two books here will break it down for you in the simplest, easiest way possible. Check them out at the link in the description. If you want the audiobook, that's available at themoneygps.com. Hang on a second, don't go anywhere. Have you seen this video yet? If not, definitely check out this jam-packed episode I did. See you there.